we could very easily see silver continue to move up and have, drift higher and still be in a bearish environment. Like overall, it'll still have a set of technically lower highs. It'll have lower lows. And this could be seen as a kind of a bearish move. And then if the stock market rolls over later this year and we start to see the dollar grab some traction again, this could end up selling off and going down in a big way. This is the same for gold. So I believe we could see silver work its way back up to about 70, maybe even 75. So there is upside potential before it could run into some pretty big overhead resistance. I think gold could rally to about $4,500 per ounce.
Financial markets are displaying turbulent momentum as precious metals pull off sharp one-day bounces despite broader technical resistance. Many retail investors mistake these short-term pops for a confirmed bull market, overlooking sloping moving averages that signal a persistent underlying downtrend. Chris Vermeulen, a veteran technical strategist and founder of the Technical Traders, asserts that gold and silver must build solid chart bases and break key resistance before establishing genuine bottoming patterns. However, substantial upside potential remains active during this counter-trend rally. Technically, silver could drift higher towards $70 or even $75 per ounce, while gold has room to surge toward $4,500 per ounce before running into heavy overhead selling pressure. Similarly, bull flag patterns suggest the S&P 500 index could rally another 10% to target 8,500. Yet, if equities roll over later this year and the US dollar regains strength, metals could face severe sell-offs. Traders should exercise discipline rather than chasing emotional moves. Now, we present the clips from Chris Vermeulen's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Well, silver's pretty much in the same boat. It's having a nice rally today. It's got this green bar popping up. And I was mentioning this to members the other day. I said, we're probably going to see this big green bar. You're going to get excited. And it's happening. I'm seeing it even with our comments and all of that stuff with what people are saying. Silver's got the same scenario. It needs time. Now, both gold and silver can still move higher from here. So let's just picture this the same for gold, silver, and miners, because they pretty much are the same trade. We could very easily see silver continue to move up and have, drift higher and still be in a bearish environment. Like overall, it'll still have a set of technically lower highs. It'll have lower lows. And this could be seen as a kind of a bearish move. And then if the stock market rolls over later this year and we start to see the dollar grab some traction again, this could end up selling off and going down in a big way. This is the same for gold. So I believe we could see silver work its way back up to about 70, maybe even 75. So there is upside potential before it could run into some pretty big overhead resistance. I think gold could rally to about $4,500 per ounce. So again, we really just need to see how this is going to unfold. When I look at it, I like to know what the long-term trends are doing. And Bitcoin's a pretty good example of this. Actually, if we pull it up and look at the recent price action, let me just go back here. It's kind of hard on the eyes, but we could say like right here, well, this is what silver and gold's doing right now, and miners, right? They're having a big pop, but the underlying trend is down. We've seen gold and silver sell off and form bear flags and move lower. Bitcoin did this perfectly. It starts to get you excited. You kind of move into it, then it moves higher and it kind of holds its ground, but then it keeps going higher. You're like, oh, this is it. It's starting. And then you realize the overall trend is down. It's just a series of bear flags. And sometimes bear flags can run out fairly wide, and then it rolls over and sells off, and you lose a lot of money. So that's what Bitcoin is doing again now, just like gold and silver. It's flagging here, holding its ground for now, but where is it going to resolve? So, that's the scenario we need to wait for. They could all turn a corner here over the next month or two and actually be in a new bull market, a new uptrend. But right now, they're stuck in a downtrend. This is just the bounce within it, and it just needs to prove itself. And then from there, we'll take positions as we need to. We see the biggest rallies, the biggest one-day pops and moves typically in a bear market. Now, you're not going to want to hear this. All your followers aren't going to want to hear this, but technically the long-term moving average is sloping down. All the other shorter moving averages are below it, prices below it. Technically, gold and silver and miners are actually in a bear market. Now, today's big rally, I talked about this with followers and on my YouTube channel over the last couple of days. I said, get ready. We're going to have a pop. We're going to have probably a big green candle on gold and silver and miners, and it's going to instantly get you very excited. And it's we're going to see a pop. And we're seeing that. We're seeing that as of you and I recording this. And people are extremely giddy today. They're all excited. They're like, this is it. This is it. And at this point, as exciting as it is, it's still just a bounce within a downtrend. So maybe this is the bottom, but we won't know that until a new uptrend is confirmed. And that means we really need to see price move up fairly substantially, and then it needs to hold its ground and build some bullish chart pattern. Now, it might not rip higher. Maybe it takes a long way and builds a base through here and works its way up. I don't know. But right now, it is exciting to see. It is a big one-day move, especially in gold miners. They're up like 8% today. But right now, it's still just, to me, it's a bear market bounce and rally. And there's a lot of, I think there's short covering. There's a lot of FOMO buying. Everybody thinks if they're not in today, they're going to get left behind. And that's usually, a reason we can see things easily sell back down, because it looks and feels like an emotional move today. But it is exciting. I mean, I'd love to see gold build a base in silver and firm up over the next couple of months and start that next rally. I really do. That would be phenomenal, but we're not quite there yet. We're still the tide's still going down, and it needs to prove itself before we can say, okay, it's built a base and now it's actually going higher. Let's get along the metal space again and ride that next leg. So the green one is the 150-day moving average. That's kind of the barometer of more or less if it's sloping down, price is below it. The 50-day, which is the blue, the 20-day, which is the pink, and then this little light blue one here is the 5-day. If more or less they're below that, then we're more or less in a bear market phase and trending down. So there's a lot of work that needs to be done that will most likely take at least a couple of months for gold and silver to carve out a bottom if this is a bottom. But I'd be aware. I think we could see this fizzle out fairly quickly too. When we look at the gold miner space, you'll notice we see these huge pops and big gaps in price. And even back over here, once it starts to get toppy, they get sold into very quickly. So as exciting as it is, 3 days from now, it could peak out and be right back down. So try not to, I don't want people to get too excited, because it's easy to get pot committed and get all in, and then it potentially breaks down. And I mean, the cleanest thing here is the definition of a trend. We have a series of lower highs. We have a series of lower lows. That's the definition of a downtrend. The long-term moving averages are layered bearish. They're sloping down. And so really, we got to let it prove itself. And maybe this is a turning point. But again, I don't believe it's the time to jump right now. Right now, it's just a blind bet. You're hoping it's a bottom. And when something's in a bear market, the odds are it's not a bottom. So that's what we need to just be cognizant of. I like to look at two significant standout highs need to be broken. I call it an impulse move. So we have this high right here, and we have this other significant high there's really kind of two highs through here. So if we can see gold miners, for example, like GDX, if it can bust through this second ceiling, so it breaks through one resistance level, it breaks through the second. After you've broken two previous highs, the first pause or pullback can usually be bought. And then boom, you'll have the second half of that move. So that obviously is the most bullish case scenario. This rips higher for another couple of days, and then it pauses, and then it starts to turn back up, and the whole sector just comes to life. That's the most bullish scenario. The other scenario I've already talked about, it could just roll over and fizzle out, right? This is a downtrend. You do get these very strong pops and gaps in a downtrend, and they can fizzle out within a couple of days. So that's why we need time to kind of prove, can it keep going higher? Can it hold its value? Will the 20-day moving average get above the 50-day? We want some time. The moving averages take time, and they're really, really basic moving averages, but they keep you, if you follow them, they'll keep you on the right side of the market. Like right now, the markets are mixed. We've got the very short-term moving averages are just starting to slope up. The long-term trend is down. Price trend analysis is down. So it's mixed. And when something's mixed, you're best just to just watch it. and just be ready. Have a game plan, have your levels picked out, but don't really take action yet, because jumping in something too early can be pretty costly if it's not the trend you think it is, right?
A significant capital shift is unfolding across financial markets as institutional funds migrate away from heavily weighted artificial intelligence and mega-cap tech stocks. While growth benchmarks experience 10% corrections due to rising volatility, broad market participation remains unexpectedly resilient. Equal-weighted equity funds continue grinding higher as capital distributes into defensive sectors. Advanced intermarket analysis combining price action, time cycles, and market sentiment indicates that recent cycle panic selling created a solid structural floor for equities. Rather than indicating overall market weakness, this heavyweight drag represents a healthy sector rotation into undervalued stocks. Disciplined capital management requires tracking these multi-month waves rather than over-trading daily noise. Sidestepping short-term market chop allows investors to ride clean trend reversals while protecting portfolio equity against sudden downturns. Now, let's get back to the interview.
If you're trying to pick a rally and a move as a swing trade, I mean, this would be like, for me, I'd be like selling some into this gap, right? I'd be like, okay, this is a huge gap up. Even just looking at the series of these falling highs, it's been a pretty nice pop. There's a good chance it's going to roll over and sell off. So I personally would be like, if this is a swing trade, I am locking in some profits and I'm moving my stop up. I want to make sure this doesn't turn into a loser, if possible. Depends where your average price is. I think what a lot of people do is they try to pick a bottom like this, and they don't know if it's a long-term play. Like deep down, you're going to want this to go to hundreds of dollars, $200-$300. It's huge potential, but you're also short-term playing it as a swing trade. So you get a move like this, and you're like, oh, this is nice. It's a huge gain. You're like 20% move really quickly here. And then you're like, you don't want to get out of it, because you're like, well, if this is the bottom, man, this is just the beginning, right? I'm going to make hundreds of percent return on the next move. So you hold on to it. And so that's the problem, is two time frames are colliding. And again, the overall right now, like technically this stock, just from really basic analysis, is actually in a downtrend. And this is just a counter trend rally. It's just a bounce up. It's a reactionary high. So that's where it comes in. It's really easy when you love a commodity, you love an asset, or the idea and the fundamentals are good. It's easy to like get in for one reason and then you stay in for another, even though, maybe should just be a trade. That's the part that people have to try to pull apart, is like, and that's why I generally only trade precious metals. I trade precious metals as my long-term position. So it's a very clear lens. When I buy physical metals, it's with a specific setup for a certain amount of time. It's my insurance policy. I'm looking to catch a huge multi-year super cycle to the upside. When I trade precious metals, I trade ETFs or I'll trade stocks, and I know they're just a trade. And I have my physical gold to back up my underlying supporting position. So I'm like, I don't really care if I get in and out of these stocks a bunch of times, because I know I have some physical gold bunkered down and going to do the heavy lifting over for the long haul, right? So that's what I like about the two playing metals, is the physical side is like, okay, that's one trade. And then when I know I'm trading in my brokerage account, an ETF or a stock around metals, I know it's a trade, and I have no problems taking profits. And so that's how I attack the precious metal space. But there's 3 different price charts on here, and this goes back to the beginning of June. Now, the top chart is the S&P 500, the middle chart is the QQQ, and the bottom one is the equal weighted stock market. And what's really interesting here is we've seen big tech, NASDAQ, AI stocks move down about 11-12% on average. So we've seen the NASDAQ go down. The S&P 500 has held up fairly well. You could even argue the S&P 500 more or less has just been kind of grinding sideways, kind of holding its ground. And that's because the S&P 500 has a lot of money moving into other stocks, but the problem is the techs are heavyweight, and the heavyweights are pulling the S&P 500 down. Now, if you were to get rid of the heavyweights, the weighting of stocks, you go to this bottom one, which is RSP. This is the equal weighted S&P 500. Every stock has the same weighting. And you'll notice money's been coming out of big tech, and the equal weighted, the stock market as a whole, has been moving up fairly significantly. And so that's where the money is rotating. The money is saying, hey, you know what? The AI space is starting to get a little noisy, a little volatile, a little uncertain. I'm going to move to different stocks. And so that's what we've seen. And then when we go and take a look at, the other, whether it's here, the S&P 500 or not, the NASDAQ, they're all the same. We've had these very big standout lows. And we just had another one now. And the standout low is more significant in the NASDAQ for this particular recent pullback. But these all have the same thing in common. There's three levels that I look at the stock market. I call it inner market analysis. It's like a three-dimensional view of the stock market. It brings in price, it brings in time, and it brings in sentiment. And when you look at the market through that lens, which is a three-dimensional, you can see beyond price, and you can see kind of what the underlying trends and the strength, the health of the market is. And each of these standout circles, Daryl, are clusters where we have cycle lows, where we have significant different time cycles putting in a low. We have panic selling. We've got money moving to defensive plays to a level where it usually triggers some type of bottom. And so we've just had one in the stock market a few days ago. And now the S&P 500 is just ripping to the upside, and so is the equal weighted stock market. Then we can step back to the longer term picture, and we've got our long-term investing strategy, which bases off the S&P 500. And it really just tells us when we are in a bear market and when we're starting a new bull market. So we can hold for, several years, and then it'll tell us to protect our capital. And then it'll give us another signal, and we're back in. And you can see this weekly chart of the S&P 500. If we zoom in, obviously this is a very, very bullish chart right here. We've got this beautiful rally using Fibonacci extension and just bull flag analysis. It shows where the upside target is in the S&P 500. It is saying that we could go with the SPY. We could see a rally from where it is right now up about 10%. That'll bring us up to about 847, which is about 8,500 on the S&P 500 index itself. So there's quite a bit of upside. The NASDAQ has double this because it's a faster moving index. It's got more volatile stocks in it. Mm-hmm. But overall, that's what we look at. We want to know if the underlying trend, if we're in a bull market, and then we can zoom down and we can trade more actively as needed in and out of the stock market, trading ETFs. Really, really simple strategy, very laid back. It's rules driven. It's all about protecting your capital first and making sure we're not riding things down. And then if we do that, then we end up with naturally holding positions that go up, and we're compounding our portfolio, 5 to 12 times a year. Each position builds on the next one. And a lot of our positions are, 3 to 8% gain, and they just keep kind of stacking on top of each other depending on how it unfolds. But it's very, very, in a way, it's a very boring strategy. A lot of our subscribers say, hey, it's like watching paint dry because we barely have any trades. So many people are used to give me this stock and what sector ETF's going on. They just want to trade. And I'm the opposite. I'm like, let's step back. The less trading we do, the easier it is. And we can catch bigger waves that have cleaner trend reversals. And so I try to step away from the day-to-day, the weekly chop. And I look for these waves that usually last 2 or 3 or 4 months at a time. And they just kind of roll through. That's where this bull and bear market strategy, are really, really powerful. You'll have the occasional signal where you get out and it pulls back and then you get back in again. But eventually there'll be one of these corrections that isn't a correction. It's going to be like a multi-year crash, right? So with very, very little effort, you're like, I know when to own the S&P 500. I know when not to own it. And that's what's really nice about this. It's almost like buy and hold. It's just saying, hey, ride the bulls and get out of the bears and, earn interest while everything collapses. And then you can reinvest at a lower price where dividends are higher and all that. And, if the market goes down for a couple of years, well, you're earning interest on your money. So you're still actually growing, even if you just sidestep it. Now, we have a strategy to benefit from bear markets and to profit from falling pricing. But, this bull and bear market signal, when to be in, when not to be, is really simple for like a retirement account and all of that, because it doesn't really take a whole lot of time and effort.
Navigating uncertain economic landscapes demands a strict operational distinction between short-term swing trading and core asset preservation. Physical precious metals function primarily as long-term financial insurance against macroeconomic collapses, whereas paper ETFs serve as tactical tools to capture multi-month price swings. Currently, metal miners and commodities remain locked in a technical downtrend defined by lower highs, lower lows, and downward-sloping 150-day moving averages. To trade these volatile market cycles safely, patient investors wait for price action to break above 2 consecutive resistance ceilings. Once an asset breaks both overhead resistance levels, the initial pullback offers a high probability entry point to capture the second half of the move. Adopting a systematic, rules-driven approach eliminates guesswork, and prevents traders from holding losing positions through multi-year market crashes. Taking modest 3% to 8% gains and compounding capital 5 to 12 times a year creates consistent portfolio growth with minimal stress. Staying patient and allowing trends to prove themselves ensures long-term capital protection. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.